Our guest today on Market Call is Andrew Moffs, Senior Portfolio Manager at Vision Capital. Now, he's going to take your questions on real estate investments, stocks, REITs. The number to call, 1-855-326-6266. Andrew, great to have you back on the show.
Thanks for having me.
So, Andrew, I want to clarify, if I may, you're okay with real estate stocks, real estate investment trusts in North America. What about globally and internationally?
Yeah, I'm pleased to cover what I can globally, for sure.
Grant. And what about home builders or building service stocks? Are you okay with some of those?
Yeah, definitely on the home building side.
Okay, well, we'll see how it goes. Okay, so we're talking real estate today. We have seen a move up in longer term interest rates. That tends to translate into higher bond yields. Any kind of rising yield, not great for real estate valuations.
It's an interesting point. What we find is when you have rates going higher because of inflation, that's a positive for real estate. Real estate is a real asset, typically an inflation hedge. And that's what we're seeing today in the system. We're seeing pent-up demand, and that bodes well over the longer term for real estate.
That's interesting. But of course, it does ultimately raise the borrowing costs for developers, doesn't it? And purchasers, the financing costs for purchasers.
It does. However, when you think about the real estate market, everything is priced off of a spread. So today, you layer on a spread that either goes higher or lower versus that benchmark rate, you're still at generational lows on interest rates. So it's interesting you bring up the corporate bond spreads. When we look at the spread between the earnings yield of the publicly traded real estate and BBB corporate bond spreads, they're still as wide as they've ever been, notwithstanding, we've bounced off the bottom on real estate stocks. So when we look at the private market versus the public market, and again, at Vision, our goal is to buy real estate cheaper in the public market than one can in the private market. We see lots of value in the publicly traded real estate space. They haven't caught up to those private fundamentals.
Well, that's interesting. So the yield on publicly available real estate investments still looks attractive compared with corporate bond yields.
Definitely, that's the earnings yield, the AFFO, the adjusted funds from operations that these that these REITs generate.
And geographically, U.S. Sun Belt still looking decent?
It does. What we do is we look for demand drivers. In real estate, that's typically job growth and population growth. And for sure, what we have seen post-pandemic and throughout the pandemic, pre-pandemic, are individuals leaving high-cost centers, coasts of the United States, trying to find cheaper cost of living, whether it's low or no income state taxes, just simply cheaper housing prices. And you find that in the U.S. Sun Belt, places like Texas, Arizona, Tennessee, Florida, et cetera. And so we're still bullish on the demand fundamentals in those markets and trying to find the right real estate asset classes in those states.
Let's take a break. Andrew Moffs of Vision Capital is taking your questions today on real estate stocks, also REITs, both in North America and internationally. 1-855-326-6266. We have Kevin sending us an email, wants to know about KBH Homes. Andrew, remind us what they're all about, KBH.
KBH is a home builder in the United States. They probably operate in about 40 to 50 markets, long track record of home building. What we like about this home builder is its valuation. This home builder trades at about 1.4 times tangible book price to tangible book value. Its peers are more in that 2.1 times range, so it trades at a discount. What I like about their business model is that they have a build-to-order model. So what we're finding today is as companies run through their inventory, as there's so much demand for housing product, what KB Homes is able to do is by having a bit more differentiation, they're able to provide a better pricing power and thus better margins. So what we find in this home builder is higher ROICs. And yet it still trades at a very comfortable 8 times this year's earnings. So this is a good home builder. We'd buy it on a pullback.
Just on home price, on home supply, BMO is out with a report arguing that on the Canadian housing market, the soaring prices, they say there's a fire right now, needs a response. They say policymakers need to act immediately to take measures to head off a bubble and a crash down the road potentially. Do you think we are at risk of a crash in Canadian housing?
I don't think so. It might be controversial to say, but I don't think so. I think the answer is supply. It's not a demand problem, it's a supply problem. For as long as people want to live in the city centers of Canada, and those city centers have constraints on new supply, whether it's a greenbelt around the city of Toronto or in Vancouver, which are positive things, you have a restriction on single-family homes, and thus you've seen real estate go vertical by nature of condos. There was a temporary setback for the condo market. Think of it here in Toronto, for example. But so long as we have the demand drivers, and they're going to ramp up again. Think next year when the federal government pushes its plan of immigration to top 400,000 new people coming to this country. I think you should continue to have a demand problem, and thus, and with the restriction on supply, I don't really see levers to housing prices come off.
Yeah, it's interesting. BMO says one thing that the central banks could do would be remove an implicit promise that rates stay longer for lower. I mean, there seems to be an anticipation, well, mortgage rates, borrowing rates are not going up anytime soon.
Yeah, it's, the push and pull of interest rates, of course, will damper any upside on the margin. But you have to remember, affordability, mortgage costs today with a two handle, I mean, you're just 5-10 years ago when it was 3, 4, 5%. I mean, this is really inexpensive borrowing costs. So you really have to have a rapid move up in interest costs for it to start to be a drag on the housing market.
We have an email from Don who wants to know about the Minto Apartment REIT. What do you think of the prospects for this one?
We like Minto REIT. We've often been bullish on this stock. It operates in the multifamily rental apartment space here in Canada. Concentration towards the urban centers, higher end in Toronto, Ottawa, for example, and Montreal. The stock is no longer a bargain like it was. It's a very solid hold. I'd continue to own this stock if any of your viewers do. We think there's upside to the rental market in Canada in the latter half of this year, going into next year as immigration returns, as foreign students come back. We think highly of Minto. So it's a company it's approaching its net asset value, at least according to on the company's numbers. We think there's upside to that. But today it's a very comfortable hold.
When investment firms, when Wall Street or Bay Street comes in and buys apartment blocks or even single family homes to rent, more capital coming into a sector, is that likely to push up rents? So could there be a backlash against investors pushing up rents?
It all depends what jurisdiction you're talking about. So when you think about apartment rentals in Ontario, that's not going to happen because we have rent control. What it does do for savvy operators, of course, is on turnover, they're able to push those rents to market because there's vacancy decontrol. In the United States, you bring up single family rental homes, a sector that we're very bullish on. We think the affordability is there for rental homes. So yes, people look at sophisticated investors as, oh, wow, look at these institutional owners will come in and they'll jack up prices. What they're really doing is creating efficiencies on how to operate and thus deliver a premium product for an affordable price. That's their mission. And they're just a fraction of the market. That's the other thing to remember. If you add up all the single family rental operators, for example, in the United States, they're going to be less than 5% of the market. You have a lot of mom and pop owners. So I think we're a very far way off from worrying about that sort of consolidation and the effect on the renter.
Nancy sent us an email, wants to know about your views on Allied Properties. Now, the boss of that company has insisted we'll all be going back to our offices. But of course, he has a lot of ad agencies, tech companies among his tenants. I wonder, are they companies that are likely to let employees stay at home?
Yeah, it's difficult sitting here today to say exactly what's going to happen in the future in terms of work from home. So the office market, all I can say is this: I can just look at the stats. And what do the stats tell me? Allied Properties REIT is a great operator of office buildings. They typically have a unique offering where they convert brick and beam buildings to cool office space. And you think about the downtown west market of Toronto, west of the financial core. So I talk about stats. For quite a long time, Allied had been working with, the wind at its back. The tightest office market in North America is Toronto. But here, coming out of the pandemic, vacancies have risen in downtown West Market to 15.8%. That's according to CBRE. That's almost double the core of 8.3%. So now they operate with a headwind. That's not to say they can't operate and operate effectively. But what you find in the office market is, in order to fill up your office space, you're going to have to give incentives. That's what tenants want, whether it's in the form of free rent, whether it's in the form of concessions or build out, et cetera. And so we're seeing net effective rents drop. And that's what's happening today. Because the question is, what will happen tomorrow? What percent of the workforce may not come back? I'm going to go back to the office, but there's others that don't need to go back to the office. So I think overall, there's a bit of a headwind overall for the office space. Allied operates within the office space. They're not immune to it, but I think they're a good operator. But I just think short term, there might be some challenges and some choppiness, but I think they're doing an effective job, at least, of leasing what they can.
Let's take a break. Andrew Moffs is... sorry, Andrew, I should... would you be a buyer of Allied Properties then right now?
Not at these levels. We were buyers far lower down than here. Today, I think it's fairly valued given the upside downside risk reward.
Okay. Andrew Moffs is taking your questions on real estate investing, REITs, companies that service the property sector, equities of companies that operate in real estate. 1-855-326-6266. John in Toronto, fire ahead, please.
Yes, hi Andy, hi Andrew. Best of health to both of you and your families.
Thank you.
Andrew, I'm asking you to compare Canadian Tire with Choice Properties, which is Loblaws. Canadian Tire with hundreds of properties and a big project at Yonge and Eglinton with Oxford Properties. And Choice Properties with Loblaws have hundreds of properties and very well established. For a dividend, as a senior for a TFSA, would you prefer one over the other as far as the safety of the dividend? And thanks for helping us out, Andrew.
Pleasure. Very simply put, I like both REITs in terms of the safety of the dividend. I am not concerned at all about the distribution. Today, Choice Properties about a 5.4% distribution yield. CT REIT a little lower, 4.9%, if that's what you're valuing off of. Obviously, Choice looks more attractive. I don't often value REITs off of their distribution yield. I care a lot more about the value that the REIT is creating in the enterprise. They're both very well run. I think very highly of both management teams. Today we own Choice Properties in our funds. We're bullish on the outlook for Choice. I think we do like Loblaws as an operator. We think the REIT has some interesting development opportunities. They're very conservative in terms of some of their valuation, in terms of the intensification opportunities that they have at many of their locations. So we feel good about the outlook on Choice. As it relates to Canadian Tire REIT, very stable. They do have that development at Yonge and Eglinton. I think that's a fantastic location. I think you have to be very patient in terms of how that comes online. It's going to be in several phases. The first one will, of course, just be the rebuilding of the Canadian Tire headquarters. And I mean, that's a very safe development because it's already pre-leased. So long story short, I own both. Today, I own Choice in our fund.
Oh, okay. Sorry, you own Choice. And what was just remind us, what was the broad reason why you preferred the Loblaw product?
We just see, a bit more upside in terms of the growth that Choice can deliver, besides the very stable revenues that they collect from Loblaws.
Okay. Mike is standing by in Toronto. Go ahead, please, Mike.
Hi, I'd like to ask about the Tricon Capital. Do you think this is something that will benefit with the rising home prices, or is there perhaps a better name?
Okay, Triacon. Triacon is the question there.
Tricon, ticker TCN. That's one of our largest holdings in our fund today. We're very bullish on Tricon Residential. They operate primarily in that single-family rental space we were talking about earlier in the United States. They target the middle market in terms of providing affordable rent for people living in the U.S. Sunbelt. They also have a smaller apartment portfolio in the U.S. Sunbelt, so hopefully there's some synergies between those two asset classes. This is a sector that's going to have tremendous NOI growth, net operating income growth this year and next, and that's the earnings provided from the homes. Forget about the fact that home price appreciation in the United States has been double-digit and will continue to be so. We're in a very long super cycle for U.S. housing. So we're very bullish on this company. It's a bit off the radar screens of U.S. investors. That's primarily U.S. investors invest in the United States through two vehicles, and Invitation Homes and American Homes for Rent in that single-family rental space. Tricon listed here in Toronto on the TSX. Like I said, a bit off the radar screen, hence there's a valuation discount. And we hope and believe that that valuation discount should close, and we see a lot of upside in Tricon.
It's interesting, and as you know, they're teaming up with Canada Pension Plan Investment Board to build apartments here in Toronto. They've started on a building apparently here in the East End, Toronto.
Correct. Yes, the Selby is a building they've already completed, but the one you're referring to, yep, they've purchased a site on the east end of Toronto. That's the roots of Tricon, is development residential with partners. So, we talk a lot about, like I did, the single family rental business, but of course, they have always had a great asset management business, and they have always developed residential. And I think what they're providing is a great product for the GTA, for the Greater Toronto Area.
Okay, so Tricon Residential getting the nod there. Amin in Calgary, go ahead, please.
Hi, thank you for taking my call.
Pleasure.
My question is on Northwest Healthcare. Is it a buy at these prices for my income and long-term hold in my TFSA? Thank you.
Thank you.
Sure, pleasure. So Northwest Health is called a diversified healthcare REIT, listed on the Toronto Stock Exchange, owning healthcare assets globally, whether in Australia, New Zealand, the UK, Brazil, and here in Canada. They recently issued units to the public. That always indicates they think their stock is fairly valued. I'd agree with that. We typically like to buy REITs at a discount to their net asset value and capture that spread. In terms of safety, yeah, very safe. In terms of they're in the right spot, they're in the right segments of healthcare, and thus I feel good about their business today. And they have a growing asset management business, which provides a steady fee income stream. So if you own it, I'd continue to hold it. I think there's probably less upside here, and you're simply owning for the yield, which is not a bad thing. But perhaps there's better value elsewhere in the healthcare space.
We are going to take a break, and we're going to check out Andrew Moffs' past picks next. He's taking your questions today on real estate stocks, REITs, companies that service the property sector. 1-855-326-6266. Andrew was on our show April 30th of last year. His first idea was BSR REIT. Andrew, remind us what they do and tell us, would you buy it again?
Yes, I would, and we do own it today. BSR REIT, they are an operator of multifamily apartments in the U.S. Sunbelt. They are listed on the Toronto Stock Exchange. They focus on the middle market, meaning affordable rents. Primarily focused in really three cities today: Dallas, Houston, and Austin. These are all high population growth, high job growth centers. And again, they're providing very affordable rents for people moving into those cities. The valuation for us does not make sense. This is a REIT that trades at an implied cap rate of 6.1%. Again, in real estate parlance, a cap rate, the capitalization rate, is the going in yield when one purchases real estate, similar to a bond yield. The higher the yield, the lower the price. The lower the yield, the higher the price. So again, they traded a 6.1 yield. You can't buy apartments in the U.S. Sunbelt at a 6.1 yield. They're typically 4% yields. But if I even put a 5.5% yield on this, it's worth north of $13 US, and it trades around $11 US. So we think this is a great little company, well run, well operated, and we continue to be very bullish on BSR REIT.
American Homes for Rent. Would you buy this one again?
Yeah, we continue to own it as well. It's had a tremendous move off the bottom, but this is one of the large operators of single-family rentals in the U.S. About 11 billion market cap. The implied cap rate of this is about 4.4%, which is in line with the apartment operators in the U.S. And I'd argue that single-family rentals should be at a lower cap rate, i.e. higher value than apartments in the U.S. This is such a great business. Earnings growth is tremendous. They're going to, American Homes for Rent should have 10% earnings growth this year, all the way to the bottom line. I just think this sector is continues to be misunderstood in terms of the efficiencies that can be created out of it. And what I like about American Homes' business model is that they're actually going out today and building their own homes for rent, which is something we hadn't seen previously. And when you do that, you can build a house that has more efficiencies, perhaps put in a more resilient flooring in there. So every time there's turnover, you don't have to replace the floor. Whereas if you go out and purchase a single family home and go and rent it, there might be more CapEx requirements for it. So we feel very good about AMH and continue to own that stock.
And finally, WPT Industrial. They operate warehouses for e-commerce companies, among other things.
Correct. And again, here, the inefficiency of a REIT that owns U.S. properties listed in Canada. And by that nature, what has it done? It's provided you the ability to buy the cheapest U.S. industrial REIT in North America via WPT. It trades at an implied cap rate of 5.5%. If I drop that cap rate to 5%, which the private market cap rates would suggest I should, this is a REIT worth north of $18. So we think it's just this nice little company doing exactly the right types of capital allocation. They're buying assets. They've now also been selling assets to partners. They just announced a big joint venture yesterday with IMCO, where they're able to recycle some capital and put it towards higher earning acquisitions in the future. So we feel very good about the valuation of WPT REIT and continue to own that stock.
Is the geography of our suburbs and cities going to change as e-commerce companies start building warehouses in population centers?
Well, the key is how close can they build those warehouses to the population centers. And so it's great to build a shed and be able to facilitate modern logistics, but how quickly can you get the merchandise within that shed to the population? So it's all about that last mile, last touch. So whether it's a brand new modern distribution facility or if it's an old 20-foot high warehouse but within half a mile from the population, I think both are garnering a premium valuation today in the private market. And it's what you're bringing up is something that's very important, is that e-commerce as a percentage of retail sales is definitely going to be sticky, if not increased from here. We saw a tremendous move up through the pandemic, and we think, meaning sticky, it's not going to go back down. You're seeing onshoring of manufacturing. You're seeing restocking of the shelves. People will want to have redundancy and backup inventory so they're not at a loss like they were a year ago for pharmaceuticals, et cetera. So I think this industry warehouse industry has a major tailwind at its back, and you certainly want to be serving population nodes that have higher growth, and thus that's where we try and focus our industrial investments.
Okay, we are going to take a break. Andrew Moffs of Vision Capital taking your questions on real estate stocks and REITs. 1-855-326-6266. Alan in Mississauga, Ontario. Go ahead, please.
Hi, good afternoon. Interested in DR Horton. Wanted your thoughts on that. Would it be an entry at this price? Looking to invest for about a 2-year period. Thank you.
Thanks.
I think it is a good entry if you have a longer term view. Like I've said, we're in a super cycle for housing, and DR Horton is one of the largest, if not the largest, home builder in the United States. I mean, it's over 30 billion market cap. They cover a lot of markets. They cover the right segments within those markets, whether it's first-time buyer, move up, et cetera. Their earnings growth trajectory is really strong, whether it's a function of deliveries and their backlog, their sales price, all going in the right direction. This is a stock we like to trade, and we've owned at various parts within this cycle. And today, though, of course, it's trading right near a peak. If you have a 2-year outlook, I think you're going to be well rewarded. We're very bullish on the U.S. housing market, and I like the way DR Horton is situated within it.
Ray is calling from Victoria. Go ahead, Ray.
Hi, thanks for taking my call. I'm calling about InterRent REIT. I noticed there's about 10 analysts following it, one with a strong buy, 7 with a buy, 1 with a hold. They seem to be meeting and sometimes beating expectations. I'm wondering if you own it and what you think about InterRent REIT. Thank you.
We do own InterRent. We think it's a buy here for sure. They are an operator of multifamily apartments in Canada, with a focus on Toronto, Ottawa, Montreal, now entering Vancouver. And they've got they've had a bit of a different strategy throughout the pandemic because of the fact that they operate in these markets with rent control, and they've been disproportionately hurt by the lack of foreign students. And think about markets like Montreal. They have been shy to just fill up space and lock in lower rents than they otherwise would have, because then once you lock in those rents, once you have rent control, it's very hard to increase them. So what they've done is the opposite path, is held out for rate and let occupancy drop. And we think that's actually a good strategy. The market hasn't appreciated it necessarily. And we think it's a strategy that will pay off. We'll look back in a year from now and say, look at the rebound that the Canadian market has had with foreign students returning, with immigration increasing. I think InterRent will be able to disproportionately benefit from those demand drivers. And so we're bullish on InterRent today. It might be choppy in the next 1 or 2 quarters in terms of the earnings results, but we're looking through that and looking forward as the vaccine rollout continues and we see better horizon, call it in 2021.
Let's head to Aurora, Ontario. Sandino, go ahead, please.
Oh, hi, Andrew and Andrew, 2 Andrews. Andrew, my question today is on Dream Office. I know that Mr. Cooper is probably having a challenging time during the pandemic with people working out of home and cottages and elsewhere. And I do enjoy the steady dividend payment that he's maintaining. But regrettably, the share prices are not going anywhere for quite some time now. Andrew, my question is it time to say goodbye to Mikey and move on? I'll hang up and listen to your insight.
He's referring to Michael Cooper, the boss of the REIT, I guess.
Yes, he is. Yeah, Michael Cooper's an adept operator, capital allocator. As it relates to the REIT itself, yes, they are operating in a tough environment. And they are going to do what they can to keep their office space full, hope to get premium rents, perhaps have to give incentives, most likely, to garner those rents. And we're seeing, that's what we spend our time doing at Vision, is going in the private market, talking to brokers, understanding where leases are ultimately getting done. So you won't see the same level of income growth that you saw previously. That said, the REIT's very stable. It's inexpensive relative to its intrinsic value. But from an earnings perspective, like I said, as it related to allied properties, you have a headwind now today in this space. So it depends what type of investor you are. For us, we're always looking for things that trade at a discount where there's a catalyst to the upside. I just talked about the apartment space. I get the temporary reason why earnings have been dampered, but I also see the catalyst and what will get us out of it. The office market's a lot slower moving than that. You have long-term leases, slower to get out of, harder to get into when you're leasing at the bottom of a cycle. So I'd say if you have that capital, why not rotate it into other stocks where you see better growth prospects? But if you're patient and you like the value story and you have a certain view on work from home and what it'll mean for the office markets, then I'd say hold on to Dream Office.
We got to take a break. We'll be back with Andrew Moffs taking your questions on real estate stocks. 1-855-326-6266. Peter is standing by in Vancouver. Go ahead, Peter.
Thank you. Andy, the great host. My regards to those two lovely dogs of yours.
Thank you.
And Andrew, the great REIT manager, may I ask you about ERE, European REIT? Last time you tipped it, it went up, but then it has gone down. So please, we need your voice to push it up again. Thank you very much, Andrew the Great.
Thank you.
Thanks for the question. Well, I think the REIT itself, their operations will dictate where the price will go, and I think it should go higher based on their operations. We continue to own ERE. This is a residential operator in Europe. They operate multifamily units in the Netherlands. Its external manager is Canadian Apartment REIT, CAP REIT. And I think it's very well run. Most importantly, I think it trades at a very wide discount to net asset value. The stock is probably worth north of $5 based on where the private market is, and it's trading around $4.30. So we see a nice spread there in terms of the upside. We like the fundamentals in the Netherlands. As I've talked about before, highly dense population is always good for apartments. Population growth is good for apartments. And they have a rent control system that has provided 3 to 4% NOI growth, rent growth, for this REIT year in, year out. So I think it's very stable. And we think the outlook is positive for ERE. So we continue to recommend that stock.
Brian is standing by in Barrie, Ontario. Go ahead, please.
Thank you for taking my call. Could I have Andrew's thought on XHB, the U.S. Home Builders ETF, and does he see upside for it? Thank you.
Thank you.
So it's a good question. I do see upside, as I've talked about, for the U.S. home building sector. The XHB, however, is an ETF. Often you find this, that you don't necessarily get what you think you're getting. And what do I mean? If you look at the largest holdings within the XHB, and there's probably about 30, 40 names in there, you're talking about Restoration Hardware, Williams-Sonoma, you have to go further down the list to get to Lennar or DR Horton, and then there's Lowe's, the home improvement center. Now, of course, all these companies touch the home building cycle, and you can have different opinions on them. But I care a lot more about the U.S. home builders, and so if you're looking for a better pure play in terms of the ETF, you might want to look at the ITB. But either way, as a long-term view, I'd be buyers of either. I am positive on the U.S. home building cycle.
We have Wanda calling from Ottawa. Wanda, you're on the air.
Thank you. I was looking for the pros and cons of Killam REIT, whether you think it's worthwhile buying or not. Thank you.
Thank you.
We're generally positive on Killam. The pro is they've operated adeptly through the pandemic. They benefit from 70-odd% of their portfolio in Atlantic Canada, which has been very stable. They have tried to grow westwards from there and have a portfolio in Ontario as well as in BC. The con might be just the valuation, which is, to their credit, they've hung in better than others, and so the upside isn't quite the same. Where we see upside in apartments in Canada are in those markets where that have been hardest hit. Think, the central nodes of Toronto, or the urban centers, the downtown core, or downtown Montreal, for example. And so those REITs that have exposure to there, you might see better upside. But Killam, we still think is a good REIT. I'd buy it at these levels. Probably doesn't have the same upside, like I said, compared to some of the other REITs, but that's not a negative. And you have a very stable distribution yield as well.
Eugene in Maple, Ontario. Go ahead, please.
Thank you for taking my call. I would like to ask potential of Smart REIT for the next 1-2 years. Thank you.
Thank you.
So SmartCentres operates, power centers, so to speak, across Canada. Their primary anchor is Walmart. So that provides a tremendous amount of stability for the earnings of the REIT. Hence, if you were to analyze this REIT relative to the other retail operators in North America, collections came in far better. But then the opposite is true in terms of the upside from here. Leasing spreads have been very muted at SmartCentres. What do I mean? When new space comes to market, maybe they'll get 1-2% rent growth. But which is far below some of their peers, whether it's a RioCan or First Capital that can get 5-10% rent growth on renewals or new leases, and similar amounts in the United States. So we don't see necessarily the same growth rate from internal prospects, but the safety of SmartCentres has been what's been attractive for many investors. I think we're in the point of the cycle where we're past the safety trade. We're now trying to understand who are the winners and losers post-pandemic. If I'm going to focus on retail real estate, I'm going to focus on grocery-anchored shopping centers, and names like a First Capital REIT, for example, where the primary tenants are grocery-anchored, or their drugstore, pharmacy, and everyday type of shopping. And we've seen the valuations in the private market for those types of real estate have really kept their value through the pandemic, where it remains to be seen on that power center side, where it's more general merchandise.
So you're not, and SmartCentres it's Walmart anchored, so it's not really a Staples REIT in that sense, a grocery REIT?
You can argue certain components of Walmart has that grocery anchor component, which is a positive. Oh, okay. But then you think about all the co-tenancies along that outdoor center. They're much more of that general merchandise type of retailer, as opposed to a smaller neighborhood grocery anchor shopping center that has the grocery store, and then it's the dry cleaner, the pharmacy, the liquor store that really attracts the traffic.
We're going to take a break. Andrew Moffs is our guest today on Market Call. We're going to get a look at his top picks right after this. Andrew's first idea is a giant in the rental space, Canadian Apartment Properties.
Yeah, so CAP REIT, We're bullish on Cap REIT because of its valuation and its the way it's situated in its markets. Its largest market is the GTA. I'd say this about the Canadian apartment space. I mean, I've talked about how the fundamentals are going to improve once we see immigration return and foreign students return. But the thing I didn't talk about is really what has been the only weakness throughout the pandemic, and that's been in the 20 to 30-year-old cohort. And what do I mean? I've spent so much time talking with different CEOs, and what have they said the silver lining of the pandemic has been? It's the fact that their children have come home, the university age or early stage workers, and they've come home and they're living at home. Well, that's not sustainable. And I think as soon as the vaccine take-up improves, you're going to see that cohort go back into the market. So we see a lot of pent-up demand for the apartment market in Canada. Canadian Apartment REIT is going to disproportionately benefit. And at the same time, where you're seeing, I think you're going to see record amount of transactions this year in the private market. And Cap REIT's not going to be able to compete because these are going to be at record prices. And already, if you applied some of the private market cap rates to Cap REIT, you'd have a stock that's well into the $60 range. And so we see a lot of upside for Cap REIT, both on an earnings basis in the latter half of this year, and then more importantly, on a net asset value basis, we think the company's very much undervalued.
Very much undervalued. Okay. And sorry, did you say there was some area where Cap REIT couldn't compete, or did I mishear you?
What I meant was they won't be able to pay the prices that the private market's going to pay for multifamily apartment assets. There's a lot of private capital sitting on the sidelines, and they're all bidding up apartments to record prices. Cap REIT does not want to pay those prices. They may as well just go out and buy their own stock. And so it's going to show that the valuation for the units of Cap REIT is pretty cheap.
Your next idea, Chartwell Retirement.
So Chartwell, largest operator of retirement residences across Canada, of course, has been a very difficult sector to operate throughout the pandemic, and they lost a lot of occupancy. I think we're very close to the bottom, if not past it. About 90% of their residents have already received one vaccine. This is a positive. We need to start seeing move-in, move-outs occurring in order to get that occupancy going. And what I like to do is I compare these to their U.S. peers, and I look at the way Chartwell is trading today, and it is at a sizable discount for a company that's probably has better fundamentals than the U.S. healthcare operators. It's trading, call it 13.5 times earnings, whereas its peers are trading at 20 times earnings. They have a long way to go, but they have to probably increase occupancy about 10%. But we definitely think it's achievable. And if so, you're looking at a stock that's trading at a very wide discount, over 20+% discount to net asset value.
Sorry, we're tight for time, but isn't there going to be a cloud over the whole seniors housing space post-COVID?
Well, this isn't nursing homes. This is retirement homes, and there's a need for this type of housing and a desire for this type of housing.
Yeah, that's interesting. Yeah, it's not nursing homes. Storage Vault is your final idea.
Yeah, Storage Vault we've talked about before. I think this is a great operator and a great industry. The pandemic proved how recession resilient the self-storage space is in Canada. It's because it's underbuilt here. Storage Vault's the largest operator, and they can provide a lot of efficiencies as the largest operator in Canada. You think about what drives this business, it's the 4Ds, death, divorce, dislocation, and disaster. And I think we just saw all of that. And what did it produce? 5% NOI growth last year and 17% bottom line growth. We think that's a great story to tell. And we think if this company were to trade like its U.S. peers, it'd be north of $5 versus where it's trading today.
Okay, we will have to leave that there. Thank you very much indeed for joining us, Andrew.
Thank you.
Okay, we are going to take a break. We're going to have a quick look at the markets. Andrew Moffs of Vision Capital giving us his insight on real estate.